For 3 straight years, this company's annual report carried the same warning that clients might one day use technology or AI instead of outside experts. Standard risk factor language. Nobody reads it. This year, that exact sentence moved out of the risk factors and into the explanation. Resources Connection lost $99 million of revenue, and in a signed filing, management named the reason. Resources Connection, which operates as Resources Global Professionals, sells finance and accounting expertise to the Office of the Chief Financial Officer. Fiscal 2024 revenue was $632.8 million. Fiscal 2025, $551.3 million. Fiscal 2026, $452 million. That is 28.6% of the business gone in 2 years. Here's what changed. The fiscal 2024 and 2025 filings both blamed reduced client spending and uncertainty in the global macroeconomic environment, the macro. This year, management wrote that the decline in billable hours was primarily attributable to softer demand for traditional operational accounting skills, as clients continue to adopt AI and automation. Same company, same disclosure, brand new reason. And the shape of the decline rules out the easy explanations. Billable hours fell 17.5%. The average bill rate fell less than 1%. And in the United States, it actually rose 2.4%. So this is not a price war, and nobody is undercutting them. Clients are paying the same or more per hour. They are simply buying far fewer hours. The segments localize it precisely. On-demand talent places accountants inside client finance teams. It has fallen from $272.6 million to $168.8 million in 2 years, down 38%. Outsourced services takes the process off the client's hands entirely. It went from $38.1 million to $39.6 to $39.2, flat. Across all 4 segments, the pattern holds. Consulting is down 29.9% over 2 years, though that one is harder to read cleanly because the company reorganized its consulting units and sold a business during the year. Europe and Asia Pacific fell only 10.8%. The steepest decline by far is the segment that bills purely for accounting labor. Now the profitability. Adjusted earnings before interest, taxes, depreciation, and amortization is the company's own preferred measure. Fiscal 2024, $51.5 million. Fiscal 2025, $23.5 million. Fiscal 2026, $5 million. A margin of 1.1%. That is a 90% decline in 2 years. And this is where the loss comes from. Gross margin barely moved, because consultant pay falls with hours. What did not fall was overhead. Selling, general, and administrative expense was $202 million last year and $202.8 million this year, flat, despite 2 workforce reductions and management headcount dropping from 662 to 591. Gross profit of $169.7 million against that overhead leaves a $33 million hole before depreciation even starts. The cost base was built for a $600 million company. One number deserves separating from the rest. Last year's $191.8 million net loss was mostly a $194.4 million goodwill write-off. Non-cash. A patient investor could look straight through it. This year, there was no goodwill impairment at all, and the company still lost $40.6 million. There is no longer a one-time item to look past. The balance sheet, in fairness, is genuinely sound. $82.4 million of cash, no meaningful debt, and total liabilities of only $87.6 million. But operating cash flow for the whole year was $1.4 million, while the company paid out $9.4 million in dividends. The dividend is coming from the balance sheet, and and the declared rate has already been cut from 49 cents to 28 cents per share. So what is it worth? At $3.90 a share, the market capitalization is about $134 million. Take out $82 million of cash with no debt, and the enterprise value is roughly $52 million for a business with $452 million in revenue. That sounds absurdly cheap, until you notice that cash and receivables alone, net of every liability, are worth more than the entire enterprise value. The market is not calling this cheap. It is valuing the operating business at less than zero and paying for the balance sheet. Under our stated assumptions, a bear case lands near 325, a base case near 740, a bull case near 1110. That spread is the honest answer. This is a binary on whether the hours come back. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.